Gosh, it's been a very eventful last week. We've had lots of global headlines. What are we waking up to this morning? No shockers or surprises, but it is definitely going to be eventful. That's the SGX Nifty for you today, indicating a cut of about 0.5% or so. But it's been eventful to say the least in terms of what's slated for the week ahead. We've got the US Fed meet, the Bank of England meet, the CPI data is in focus, UK as well as Japan CPI data that will be coming out. And of course, all eyes on the US Fed meet, whether or not they're going to pause on the interest rate hikes, that's going to remain a huge question mark. So Nikunj, clearly looking at a lot of global events, and this after the fact that we've wrapped up last week with a cut of close to 2%. That little recovery did play out on Friday.
You know, the UBS Credit Suisse bailout, I was hoping that you would see more green on the screen, but unfortunately markets are not reacting to a big bailout. So that just tells you the underlying template of the market is not all that, charged up. This arguably is the most important week from a central bank policy action. Now the Fed in a sense will be the decider. If Fed decides to increase rates, it's an indication that they feel that the US banking system is stable and they are worried about inflation. If they don't increase interest rates, that means that Fed is nervous about the US economy and the global economy's ability to digest another rate hike, and that also could be an indication that markets are slightly fragile in terms of the near-term compulsions. So it's a tricky week to call, but it's an important week which in a sense will decide the course of the short to medium-term market action. What is important here is that, and the price action is not resonating with what the global news flow is, the concerns in the world are getting addressed. The collapse of Silicon Union, SVB, the rescue of Credit Suisse by UBS. Central bankers are burning midnight oil to ensure that global financial markets remain stable and 2008 crisis is not repeated. But that in a sense is not really giving any kind of a relief or impetus to the bulls. So that's the tricky part, that Asia is down and out, Nasdaq futures are up, gold is up, Bitcoin is up, and SGX is indicating that we could be in for a poor start.
Oh, well, yes, and it's very interesting as you point out. It's not like it's a complete safe haven rally or something, because gold is up, but yes, Bitcoin is also, rallying as we speak over the last week as well. But Nikunj, to the point that you talked about the Credit Suisse deal, do you think the contagion that the market was worried about will be over with the deal that is talked about? Because it's not a very good deal coming in for the minority shareholders, right? It's valued at what, $3.3 billion as compared to the market capitalization of $8 billion, plus the written down value of the bondholders, etc. as well. Do you think this contagion of various banks coming under pressure will at least abate for now?
See, Anisha, if you don't fix it now, then we are looking at perhaps a bigger problem. And the bigger problem, we've seen that collapse of Lehman Brothers, what it actually caused. Ultimately, government had to come out and step them out, and buyouts had happened, where the TARP money was given to the banks, and they, in a sense, then they were able to resurrect themselves. Some banks went under, some banks were merged. So that is a typical pattern in which global financial markets would move when somebody is caught swimming naked. That's how it works. From the lens of Credit Suisse, you may argue and say, okay, what is there for minority shareholders? But when you're a bond investor or when you're an equity investor, minority, you're taking a risk.
Yeah.
The primary objective right now is to keep the depositors safe. So central bankers are keeping the depositors safe. Imagine if there's a run on any other big bank, then what kind of system are we looking at? I mean, banking is a business of confidence. If the confidence goes away, if central bankers don't kick in, then there is a problem. One. Second, when you are an investor or a equity investor or bondholder, you are ultimately taking risk. When the stock of Credit Suisse went up, or for that matter, any stock went up, the upside is also yours. Now, if you are an equity investor and if you are a bond investor, ultimately you are taking a risk. You have to do your homework.
Yeah.
So that's the way how financial markets move. It's not a place for saints, it's a place for sharks. Central bankers have to come out and they have to stem the run on the bank, stabilize the system so that we don't see when there is a problem, you have to sort it at the initial stage. And if you don't fix it at the initial stage by coming in and giving confidence to the financial markets, then it would have created it would have been a financial Armageddon by now. We would have been staring at scary levels. There would have only be red on the screen and everybody would have been running for cover.
Yeah, no, in context of that, the markets haven't done too badly. We're just less than 10% away from the all-time high on Nifty as well, despite two banks collapsing in the US, plus this entire Credit Suisse issue. And just to highlight a couple of details, 3 billion Swiss francs is what UBS will pay. They'll also assume liabilities to the tune of $5.4 billion in losses, and 17 billion is what is kind of a write-off that the bondholders are expecting as far as this deal is concerned. But looks like it's a done deal because it's got a lot of backing coming in from the UK, bank as well. You have the backing coming in from US Fed, as well as positive commentary coming in from Swiss government, who's actually brokered this deal. So that is something which the entire global market Avan is talking about.
Absolutely, and that's a big headline, the fact that we're taking steps, that steps are being taken to stem the banking crisis. How did that play out overnight? A quick check-in. You had most of the US markets which wrapped up in the red. The Dow futures, though, is showing a bit of a green tick. You've got the Asian markets, barring Shanghai as well, that are piggybacking on those Wall Street cues, and for now the SGX Nifty indicating a weak start. But to our markets then, and Friday's trading session had a glimmer of hope, 17,100. We are just on the brink of that level, but we did underperform our peers. We lost out about 1.8% for the week gone by. It was banks, telecom, autos. Those were some of the sectors that fell. FII sold close to $0.2 billion worth of Indian equities. The bond yield fell to about 7.35%, and you did see the rupee as well, which depreciated about 0.6% for the week gone by. So now, Nikunj, if we were just to focus in on what our markets have done, and as she said, not too bad in terms of what we've been thrown up. The fact that on Friday 17,100 was recouped, and now we have positive news from overseas. Do you think that we're likely to pull through from these levels?
I mean, SGX is telling a completely different story. Look, we had one good Friday. That's about it. Otherwise, last week was a terrible week, if you frankly ask me. Now, just like one swallow does not, make for summer, one good day does not mean that we are out of the, woods, so to speak. While I was hoping that we could be in for a solid start, and you built on that because global cues are stable, the problems in the world, at least for the moment, they are getting sorted. But if there is nervousness in the market, that means either markets are telling you that they are not done with the selling yet, or markets are decisively waiting for some kind of a view from the Fed before you will see any kind of a price action. The problem with this kind of a market, it's getting very shallow. The bias is down, the participation is low. You don't have very sharp unwinding. So it's this gradual decline where you know that you're headed lower, but you're headed lower slowly. You know that you're not going to go upside, so you don't want to participate. And that's always a very, dangerous market to be in, because the markets are not showing strength, and the lack of participation and the lack of negative price action is forcing everybody not to participate. See, if there's a big fall, markets will fall, they will adjust, value will emerge. That is not happening. The problem is that you've been just getting pushed here, pushed there, pushed there. 2 good days, 1 bad day, followed by 1 good day, another 2 bad days. And that, in a sense, is really taking the momentum out of the market. And it's not a great gratifying feeling if you've participated in the market. And that's having impact on volumes, mood, technicals, participation, narrative. Am I missing something here? Yeah.
Yeah, it's very listless, very momentum free, and as you point out, the weakness has been that as far as the volumes is concerned as well. But one asset class which has managed to outperform a tad bit in this fall that we saw last week was gold. In fact, there is scope for gold and silver to touch more gains. That's the word coming in from Gautam Shah, the founder and chief strategist at Goldilocks Premium Research.
I think the beauty about gold is that anything happens in the world, on the negative side, gold is the first to go up. And we've just had too many developments in the last 1.5 years, or rather since the COVID times. And with this development around SVB, we've seen this $100 move on gold. It's already at 1915, 1920. I think it will get past 1970 in the near term and eventually move past lifetime highs of 2017. So there is 7, 8, maybe even 10% upside on gold and about 15 to 17% upside on silver. And we strongly recommend topping up on both these precious metals at current prices and on any small decline. Yesterday, you had a sort of a mini selling climax with the Nifty going close to 16,800. And from there, we've seen a bounce. So I think whatever has happened is very normal. Even the Bank Nifty has reversed from the 38,500 level. And we've seen these bounces a few times in the last couple of months, and they've just acted as a trap. People hope that it's a bottom, but it does not end up being a bottom because the markets go on to make a lower low. So I would remain bearish. The trajectory will remain down. It will be volatile. It's not going to be a linear decline because we live in a very dynamic world where too many things are happening on a daily basis. So you will see a lot of volatility, but the sequence of lower tops and lower bottoms will continue. So I think that the trend is clearly down. Pullback rallies should be sold into. This has been the stance for the last 2.5 months, and this remains. So do not get carried away with the uptick.